Hello, everyone.
Yes, we can hear John.
Perfect. Thank you. My name is John Jet Tusabe, and I'm based in Kampala, Uganda. And greetings to all the East African brothers and sisters who are on this call and those who are outside East Africa. The topic this afternoon is a very interesting one because of its global impact. As my colleague James mentioned, the aspect of base erosion and profit shifting is a global one, not only affecting East Africa, but affecting many other countries around the globe. And it's mainly coming from globalization, as you may have noted that with increase in globalization, trade amongst countries has increased drastically over the years, and that has created a gap in tax because, as you know, when it comes to tax matters, each country imposes tax based on its laws. And because of globalization, countries or businesses that have cross-border trade are able to utilize loopholes in the tax laws of the various countries to be able to pay little or no tax at all. And that means that a smart multinational enterprise is able to use the services of clever people like Steve, Juma, and others to structure their businesses in a way that they pay less tax or little tax in a high tax region and move the profits to a country with lower tax rate or no tax at all. So as a consequence of that, rules around how to stop or mitigate the effect of profit shifting from high tax rate country to low or no tax rate country, those rules are necessary or have been introduced to close that gap. And as East Africa, of course, as you know, we have many enterprises that have a cross-border trade. That means that as East African countries, each of the countries has come up with various rules to mitigate the impact of multinational enterprises shifting profits from the East African country where those profits are generated to countries that are outside Uganda where they pay little or no tax. And this afternoon, we are privileged to have the expertise of my colleagues to take us through the intricacies of BEPS in each of the countries and how we need to be aware of the rules and at the same time ensure that we support the companies we work with, we support the tax authorities we might work with, we support the organizations that we work with in ensuring that this aspect of profit shifting is dealt with in accordance with the laws governing the various East African countries. I thank you very much and look forward to hearing your questions and contributions during this webinar. Thank you so much. Enjoy the presentation of the experts.
Thanks a lot, Jet, and everyone who is joining. My name is Steve Okoth. I'm a tax director here in our office in Nairobi, and I'll be giving an overview. And after my overview, I will hand over to my colleague Magdalene Wavinya to continue with a portion of the presentation. And mine is actually very simple. to strike the key issues that multinational entities need to put in mind in regard to BEPS and what BEPS has really caused to them in terms of additional compliance requirements. Everyone already knows that BEPS is a process of reviewing international tax regimes worldwide. And this international tax involves other aspects of international tax and more specifically transfer pricing. But it's a broad movement that has taken place. If you could go to slide number 9, as I give the overview. It's a broad program that was instituted after the last global economic recession. And that global economic recession revealed a lot of weaknesses in the operation of the global economy and the operations of multinational enterprises. Governments all over the world were facing a lot of pressure in terms of revenue losses, in terms of realization that large multinational entities had been probably taking advantage of the international tax system and the dichotomy between different legal regimes to actually drive a tax advantage for themselves. This was a program that was instituted under the leadership of the former US President Barack Obama. And changes have been coming over the years. In international tax, the OECD guidelines have been changed a number of times. The OECD Model Tax Convention has been changed a number of times. There have been publications that have been produced and reviewed in regard to taxation of intangibles, taxation of services, or tax treaties, and how they are worded and described. So changes have been coming through, and multinationals have had to deal with this. And more specifically, I will narrow down to what really is the implication of this to businesses that are operating in Eastern African region, because Video East Africa operates in Kenya, Uganda, Tanzania, Rwanda, DRC, Burundi, and Ethiopia. And we also have a close affiliation with our Mauritius and Madagascar team. We work very closely with our UK, South Africa, UAE, United States offices. Those are the offices that we really work very closely with. And a lot of our clients, we find that are really, especially our multinational clients, we find that are really subsidiaries or branches of companies, multinational companies that are located in Europe or North America. This is really the landscape out here. So the question of the day is, what should be the concern for the people who are running operations locally, for the people who are running businesses in Kenya, for the people who are running construction projects, which have been won by multinational entities in the region in our Eastern Africa.
Steve, are you still there? Steve, we lost you. Can you hear us? Steve, can you hear us? Steve?
Oh, I apologize for the disconnection. It will not happen again because now I've rolled up my backup. Can you confirm, James, that I'm audible?
Yes, I can hear you, Steve. Please proceed.
James and Jess.
Steve, we can hear you. Please proceed. Steve, can you hear me? Steve?
Can you confirm if I'm
Steve, we can hear you. Please proceed.
audible? Yet I'm asking you.
Yes.
I'm audible. Okay.
Yes.
Okay. So I'll proceed. Apologize for that. The first issue is the taxation of digital economy. Multinational enterprises that are selling directly services to customers in the region. For example, in Kenya, we have the DST tax, and we also reviewed our VAT laws to capture this kind of services for VAT purposes. We've reviewed our Tax Procedures Act to put in place the mechanism for appointment of VAT representatives. These are some of the changes that have been effected in law in pursuit of the BEPS project and BEPS ideas to our tax compliance requirements. And these are some of the things that now, or those who are really selling directly, having customers here, have to contend with. The other one is to the other project was to neutralize the effect of hybrid mismatch arrangements. This, so far, in my experience, has not been a big concern for us, especially and more specifically, I'm referring to Kenya, because in Kenya we still operate the English common law, or that has more precise definitions of what a business is, what a loan is, what equity is. So this has not been a key issue for us. Strengthening of control foreign company rules or limits to the best erosion and profit shifting in terms of interest deduction and other financial payments. We've seen the restriction of the interest deductions to 30% of EBITDA. There are developments across the region, and my colleagues will be touching on this. On harmful tax practices in regard to transparency, this is a big issue of concern for everybody because the changes that are coming in place are really attacking the very fabric of privacy, the very fabric of confidentiality. Trade and commercial secrets are becoming under a lot of scrutiny. We are finding Kenya, more specifically, has signed a lot of information sharing arrangements. We have the common reporting standards that have been brought to light and have now been operationalized. So the issue of transparency, of information, and of reporting is becoming increasingly sharing, and multinationals we call upon everyone who is operating a multinational or outfit out here, or a component of a multinational outfit out here, to pay more attention in terms of documentation, in terms of information that has to be maintained, in terms of the appropriacy of that particular information. And in this regard, we can provide our expert help or in piecing up such information and ensuring that it is availed in the correct order when it is called upon. And the calling upon can happen at any time because it's based on the notice or issued by revenue authorities. So that is an issue that I will be putting a focus on after this overview. And this relates more closely to the prevention of treaty abuse. Kenya has LOB clauses. This is the limitation of benefits clauses, which tend to also be in conflict with other aspects of law in Kenya. Now, the limitation of benefit means that your access to a double tax treaty or benefit, your access to a double tax treaty protection as a multinational outfit, or even as a person who is making payments across the borders, or access to lower withholding tax rates may be affected, access to other benefits may be affected if it is revealed that that particular company who is receiving the payment is not controlled 50% by the residents of that particular country. So this came in sometimes back under the focus of BEPS and under the pressure of BEPS. Of course, we know that this conflicts with the other provisions of the Tax Procedures Act and the provisions of the Constitution, which says that the statements in the double tax treaties or any other treaty for that matter that Kenya government has signed supersedes in legal effect any other contrary provisions or under the Income Tax Act. So this is something that has not been adjudicated. It has not been adjudged, but it is a point that has to be looked into, especially when transactions are being structured. Then the prevention of artificial avoidance of PE or status. So Kenya Revenue Authority and indeed other revenue authorities in the region are putting a focus on PEs. Construction companies, engineering companies that are doing work here are already under scrutiny. Audits have been taken. Some assessments have been given, and disputes have gone to tax tribunals. We also have service companies that are providing sales, warehousing companies that have a relationship with sister companies that operate apps through which people can purchase goods online. So you find a multinational entity is having a warehousing facility here. At the same time, it is having an app which it can sell goods to consumers directly or without going through other intermediaries. These kind of arrangements are being brought under scrutiny and are being verified as to whether they are in compliance with the transfer pricing regulations and with international tax requirements. Then aligning TP outcomes with the creation of intangibles. This is not much of a concern for us because we are a net importer of intellectual property. We are net importers of brands and similar items developed through the intellectual process. So this has not been a focus for us, but IP has been audited in international tax audits across the region. Then aligning TP outcomes with value creation, risks, and capital. So this is a development under BEPS, but the problem we are having in Kenya, more particularly, is that the Revenue Authority is putting more pressure, especially on arrangements where we have a contract being implemented at the same time. Simultaneously, different components are being implemented by the head office and their local subsidiary, or head office and their local branch. You find that, and these are large contracts, road construction contracts, engineering contracts in water, in energy, similar high profile deals that are of material scope and nature in terms of really the value of the contract. These are really being put under a lot of focus, and I would urge that to avert risk of confusion, because this issue of value creation is quite sophisticated from an international tax perspective. I would urge multinational enterprises to actually obtain advance rulings or in terms of the tax treatment of their transactions. You obtain ruling in advance to avoid adverse outcomes or to avoid a conflict or a dispute in the future. Let people sit down when the contract is being negotiated and when the contract is commencing the implementation. Let people sit down with the Revenue Authority, and a confirmation of the tax treatment is then put in place. Because you can find yourself in a state where an audit now comes in, and we face a situation where the intensity of the audit, the rigor of the audit, the documentation that is required out of the audit is quite intense, and it puts a lot of pressure on the project, puts a lot of pressure on the business. So it is better to play safe and to obtain a private ruling in advance instead of managing a dispute in the future, even if you easily win that dispute at objection review level, or if you win it at the tax appeals or tribunal level, or even if it is just an audit and the dispute just takes place within the audit, it is still quite something of scope, and it is better where value is being generated. Projects that you have both offshore component and onshore component, it is better to have a confirmation so that this does not become an issue later on. That's the most advisable position from a tax risk management or standpoint. Then high risk transactions, or that is also relating to the same point that I've mentioned, measuring and monitoring of base erosion and profit shifting, or is there. Then aggressive tax planning arrangements. So far, the rhetoric against aggressive tax planning has been high gear, but from my experience in the audits that I've witnessed and handled, and also the ones that we are monitoring in the market, we monitor what is happening in the tax space very keenly. We monitor all disputes and the key audits that are taking place on a daily basis, so we know what is happening. This one is more of rhetoric than actual force behind it. There has been a lot of fidelity to the international tax laws, or there has been a lot of fidelity to transfer pricing rules, actually. So anti-avoidance is not an area that I've seen a lot of focus from KRA perspective, because most of the time it's quite difficult to prove that a transaction has been designed solely or principally to defeat tax. But this is something that still ties to the advice that I gave earlier on, that it is better to be safe than sorry when it comes to these transactions. Then transfer pricing. This one everyone knows. You need to have proper transfer pricing documentation. It's not something that we can stress further, because most of the people really have undergone transfer pricing audits or inquiries of one nature or the other. If you have not gone through this, then just be sure it's on the way. Now, the issue with TP is actually not it's not about the documentation, because documentation, you will most of the time come to a professional like ourselves who will prepare good documentation and who will be able to defend the documentation. The problem with TP is the failure to actually implement the documentation. You have a proper document and then you implement it for 1 year or 2 years, and then the rest of the time you find people are just pricing things according to instructions or from above, according to memos that are being circulated within the group, and this really conflicts with the TP documentation. And then when we now have to resolve that issue, it becomes quite tricky, because you are actually going against your own document. It's you against your own word. So that is the issue with TEP. Then the dispute resolution mechanism. My take on the dispute resolution mechanism, especially the proposals that have been made for mutually agreed procedures, they have not been effective so far. They take long and they are not effective. So far what we have is basically the current dispute process, where audits are undertaken on transactions, and probably assessments or findings are released. And after those findings have been released, then there is a dispute or resolution mechanism which kicks in, which involves the review of objections or appeals at the tribunal and at the courts. So that is the issue. And then development of multilateral instruments. We know that we are now required to keep master files, local files, and all these things have to be maintained. So this is really the overview of the development so far and its domestication in the region. So I'll just go to the key points that need to be put in mind in preparation for compliance with the requirements that are coming through in the region, or some of which the pressure is coming from international organizations like the OECD putting pressure on KRA, or like the ATAF putting pressure on KRA, or like the IMF putting pressure on the National Treasury. And this pressure is going across the region. We all know that we are now under a lot of pressure as countries in the region to begin to toe the line with these international organizations and international requirements. And if you don't put in place the mechanism, then there are ramifications that come with that. We know the other time Mauritius faced sanctions for not sanctions, but was put on the gray list for some time because of this, and they had to really review their process and ensure strict compliance with the demands that are coming down to these developing countries. So one of them is really increased transparency. You have to contend with this. You have to contend with the pressure on transparency. This is something that has now come, or secrecy and confidentiality have come under a lot of pressure. I know the laws that are there in terms of protection of data, protection of business interests and all this, but they are coming under a lot of pressure. CRS has already come live. So it means your information may actually flow across the borders to other revenue authorities. It means that you have to actually really be ready for this kind of information being shared with the revenue authority. You need to really now be prepared that you may actually at some point, or either your information coming from outside may be used against you automatically, or it will be something that may be used to flag you for an audit. So this is transparency is something that has come through and has to be contended with. And the only way out is to prepare your documentation such that there is nothing that puts the business in jeopardy, or that defeats the interest of the business, or because preparation was not properly done. Then we have the issue of compliance costs. This documentation So we also have the issue of the compliance cost. This documentation have to be prepared by professionals, and they have to be reviewed. These systems have to be reviewed by professionals. You have to put in place your people. You have to train them to be able to comply, or you have to review your documents. So the cost has to be budgeted for, and this is something that has to be first. Then there is also the risk of double taxation if things are not properly done, if transactions are not properly structured, then you face the risk of double taxation. Transaction being taxed here, and then it's also taxed there. The uncertainty that I mentioned about, and I suggested, that we now have to go into the era of proactive or compliance or proactive tax risk management. Instead of waiting for an audit, you might need to actually have certainty by taking action and ensuring that your transactions are confirmed. And this may have an impact on your business model. Some business models after review may have to be changed or may have to be restructured. So that is something that you have to contend with. For large multinational entities of significant reputations and names, an attack on a subsidiary here or an attack on the branch here may hurt the reputation of the entire multinational group, and this is already happening. What happens here may actually taint the name of the entire group. So we have to also look at it in terms of reputation risk, or not just tax risk. And of course, we have litigation coming in, or matters going before tribunals and courts, or the risk of litigation is also there, or increased scrutiny is there. I've mentioned the tax reforms that have already taken place, or you have to be reviewing the documentation that we regularly send to our clients every year, and from time to time, in terms of the changes and the requirements that you need to fulfill in terms of those changes. And this really calls for two things, really. All the issues that you have to contend with. My take is that the sound and the advisable position is to have a tax health check. And that tax health check should focus also on your international transactions. For the economy of it, for the cost of it, you may undertake it together with your other tax compliance obligations. And then you get a report as to where you stand and where the risks are from a professional professional's view. After such a health check, then you take measures to plug the gaps. This is what I will recommend as the best way to manage the risk that have come because of BEPS and all these developments. Of course, we remain available in the event risk is not managed and an audit comes through. We remain available to help manage the audits and to resolve disputes. We have tax dispute resolution experts across the region. So from that, at that level, I therefore hand over to my colleague, Magdalene Wavinya, to continue with the other aspects of the presentation. And I request James to go back to her slides.
Thank you so much, Steve. Let's immediately go to Magdalene. I hope you're ready. Magdalene, can you hear us? Magdalene, can you hear us?
Yes, I can hear you, James.
Okay,
so
we can proceed.
So thank you so much, Steve, for the broad overview about this presentation of today, BEPS action. So I think James gave a broad overview on the global situation. Steve has given the regional situation within East Africa and what are the risks associated with the BEPS. And I think now we know the risks, we know the situation, and the best thing we can do is to understand what is BEPS action. So James, perhaps we move to the next slide.
Magdalene, is that fine?
Next slide. Overview of BEPS action. Thank you, James. Now that we know the associated risks and the situation on the ground, it is also good for us to understand what is BEPS action points and what does it mean actually. The BEPS, the definition of BEPS actually means base erosion and profit shifting. And when we talk about base erosion, we are talking about eroding the tax base such that there will be no taxable income within the country. So it's moved to another country. We'll have eroded the tax base so that that income will not be taxable in that particular country by engineering processes and strategies to avoid tax. So profit shifting, it's relative also to the tax base. We'll have produced income within the country, but because you do not want that income to be taxed in the relevant country, then you shift it to a lower tax country where it will be taxed. So you'll have shifted the profits from the country where the income has been generated to a country where the income has not been generated but taxed at a lower rate. So I would go straight to how these are started, the BEPS action. You can see the milestones. In July 2013, we had the 15 BEPS action points which were set up. And by 2015, this was published in a final report. And it was just outlining the statements on the consensus and the recommendation that it be reached so that we have the BEPS project moving. So by 2015, October, then the OECD and the G20 countries continue to undertake further work. And that's why we are discussing today, where are we on the BEPS action? The next slide. I think Steve has gone through the list of the 15 action points for BEPS, so I don't need to go through again. Perhaps we could move to the year. So why do we need? Why did we have to have this BEPS action? And there are three headings there you can see. One is for coherence, and I've grouped in terms of the different action points. Where we have the hybrid, the controlled foreign country rules, issues relating to interest tax deductions, and harmful tax practices. In terms of substance, you're going to see what's that, and you're going to go deeper in terms of treaty abuse, fee, intangibles, and TP risks, and also high-risk TP transactions, issue relating to transparency. And lastly, we'll talk about the multilateral agreements. So I would start with the digital economy, which is our BEPS action 1. So we can move to the next slide. So the next slide. We have our BEPS action number 1. And this action, BEPS action, ideally, it's meant to address the issues relating to tax challenges that have come up as a result of the digital economy. Now, digital economy has posed challenges to the international tax rules. So the current work in terms of BEPS action 1, we are having 2 pillars, which are ongoing, and the deliberations are ongoing, and we expect these changes to be effected by 2024. So the first, the pillar number 1, this one is about, it talks about how do we reallocate profit that has been generated by a particular multinational company. So yes, where will be the tax be paid? Will it be paid where the income has been generated, or will be paid where the income has been consolidated? So on what basis are we going to allocate these profits? And then it's also giving us, how do we proportion these profits between where the income has been, the country where the income has been generated, and where the multinational is actually operating, or where we have the head office. So we have pillar number 2, and this one is providing a mechanism to lower the erosion of the tax base. And we are going to see in the next slide, we have a system where we are, the proposals are that we have a minimum tax, such that we'll have capped with the shifting of the profits to other countries from where the income has been generated. So we can go to the next slide. So we just, in this one, we just want to know who does it cover. Pillar number 1, we can see that it targets the groups that are greater than have a revenue of 20 billion and have profitability before tax of at least 10%. Yeah. So, and then the allocation of these profits is targeted such that it will be done or allocated to the markets where these companies are generating the income. For example, a multinational company in Kenya may be having branches or subsidiaries in Uganda, Tanzania, and Ethiopia, but it generates an income of 100 million, or a revenue of 100 million. What this pillar 1 is telling us is that we have to retain 10% of that income in the country, in Kenya, and the rest of the profits will be allocated to the 3 other entities. We are going to see what is the percentage as we move to the next slide. So the pillar number 2, pillar number 2 is also talking about the group's annual consolidated group revenue, which is more than 750 million, and in at least of the 4 immediately preceding fiscal years. So for those companies who have revenue of greater than 750 million euros, then they'll have to pay minimum tax if this goes live. So we are going to see what are some of the entities that have been excluded from the pillar 2, and one of them are investment funds, real estate investment vehicles. We have also pension funds, the government entities, the international organizations, and NGOs. Then we also have those countries that have less than 10 million euros equivalent in revenue. So with that, now we can see, we can move to the next slide and see how is this one going to be applied. I've tried to come up with a kind of a simulation on how we can approach BEPS action number 1 in terms of allocating the revenue and also ensuring that we are minimizing erosion of the base. When you look at the left side of the slide, there is the pillar number 1, realigning who is to be taxed. You can see we have a multinational. This multinational has subsidiaries country A, B, and C. They have earned revenue, and when you look at that, then under pillar number 1, then the taxing rates on more than on that revenue, then 25% of that revenue will be allocated to the subsidiaries, simply because the customers of the multinational are located in these 3 countries, A, B, and C. But 10% has been retained by the multinational, and 25% of the balance will be allocated now to the countries where this income has come from. So that is pillar number 1. Pillar number 2 is proposing for minimum tax to be paid, and you can see that the proposal is that the minimum tax should be at 15%. Before I move to the right side, then under pillar number 1, the taxing rates on more than USD $125 of profits are expected to be allocated to the market where the income has been generated. That is in the specific countries. So under pillar number 2, where we are going to have a minimum tax of 15%, then the global minimum tax at a rate of 15% is expected to be generated around USD 150 billion in the new tax revenues. And that is the approach. They can foresee that if we use pillar number 1, we're going to make or save taxes USD 125 billion. If we go for the minimum tax, then 150 billion. So that is the current situation and the current discussion ongoing. So we can move to the next slide. So what is the approach? What is the OECD approach? How are they doing this? They have divided these two items into something they are calling amount A and amount B, and this is for the pillar 1, yeah, on profit reallocation. So in amount A, the taxing rights to the market countries and amount A rules, they'll be given taxing rights. So the attribution of part of the group residue revenue will be allocated to these countries. That is why we say 10% will be retained by the multinational, and 25% of the balance will be allocated along those among those other countries from where the revenue has been generated from. So in this case, the proposal is that it will be implemented in 2024. And I think this is something that the multinationals needs to think about, and especially on issues relating with digital tax economy, which have come up in Kenya. We are going to hear some, the next speaker will be speaking about the application or what is happening currently in our countries. So in amount B, where we have the simplification of the transfer pricing rules. And now in this case, they propose that this will cover all the businesses, except those who are over 20 billion euros. So, but the baseline return for routine marketing and distribution functions will guide this. So it's also expected that one will be implemented in 2024 to 2025. So the key items that we need to take away, you can see them in the next slide, is that can move to the next slide. So what do we need to take away with us today on the BEPS Action 1 is that by 2024, we need to act and try to look at our transactions. Where are we in relation to BEPS Action 1? And also we need we need to be ready because of transparency. There might be requirement for the financial statement disclosure for 2023. And also, the focus is more on those companies that have a revenue of more than 750 million euros annually. So we also need to share the information across the globe. And I believe this is going to help us discuss and see how can I be assisted in line to align with BEPS Action 1 so that I'm not caught in the mix. So I think that is BEPS Action 1. We're going to look at BEPS Action 2, and Steve had mentioned something to do with hybrid mismatches arrangements. When you talk about hybrid can be different aspects. For example, we could have hybrid structures that relates to structuring of intercompany loans, such that a loan could be either an equity or the financing could be either in form of an equity, and at the same time is also a loan that can be converted into an equity. So in that case, it restricts in terms of payment of dividends, and at the same time there is also a restriction in terms of interest payments, which attracts withholding. So that is one of the hybrid structure I can talk about, then we have also had other structures. We are going to see sample structures. So this BEPS Action 2 is talking about how do we neutralize the effects of hybrid mismatches. And it has given up, you can see that the aim is to reduce or to stop interest deduction with no income as a sort of an instrument. It also recommends for domestic laws that will curb the structuring or having those hybrid mismatches. And therefore, we can see by 2017 July, the OECD report set out recommendations for dealing with branch mismatches, and also to align the structures in terms of the hybrid mismatches. So we can look at the overview of some of the samples of the hybrid mismatches. So you can see, according to the ATAD framework, normally ATAD refers to the Anti-Tax Avoidance Directive Framework 2, which guides on how to counter the hybrid mismatches arrangements. So there are rules that have been laid down to curb these hybrid arrangements. So the first one is we are talking about hybrid instrument. I've talked about a loan. Usually hybrid instrument is a financing instrument. So it can be structured as equity, or it can be structured as the same time with characteristics of a loan. So there is also a structure in relation to hybrid payment to hybrid entity. We also have payments to hybrid structure relating to PE, and also payments to PE, others relating to payments to hybrid entities, and also assumption of payments to PE, and also double deductions. So out of these, I'm not going to go into details of these. I've picked a few of them, and we are going to see what does the BEPS Action 2 provide, and how do we counteract this. For example, I picked the first one on interest deduction. Here we have a company here that is related to a company B in Germany. Company here has issued a loan to company B. So we expect company B to pay interest to company A. So in that regard, while B is paying company A the interest, then it has to withhold, which is supposed to be withholding taxes to be remitted to the company, to the tax authorities in Germany. But what are the facts on the ground? Company A has shares or has interest, all shares. We are talking about deduction of interest. So in this case, company A owns company B through shares, but it has also issued a loan. So company B qualifies under the law as an opaque company or transparent. So, but it's treated as a transparent under the law of Section A. So, Elite B is to be entitled to pay or deduct interest under its local taxes law, but under the law of State A, there is no income that is to be taxed, because it's treated as it qualifies as an opaque, not as transparent. So in this case, how does BEPS Action 2 deal with this structure? So there are two possible counteractions that are likely to be applied here. One, Entity B is denied to a tax deduction for the interest expense, simply because Entity B is asked to pay interest to A. But they also have to deduct this when they are preparing their financials or determining their tax. They are doing their tax computations, so they have to deduct interest expense. So to counter this arrangement, then they are denied that chance to deduct the interest expense, such that interest expense will be taxed in B. Now the other option is that state A includes interest income in respect of the loan. So there are two options. Is either A to disclose the interest income, or B, not to be allowed to deduct the interest expense. And that is how that structure on deduction of interest is counteracted under the BEPS Action 2. We can look at another structure, perhaps in relation to PE, permanent establishments. When you look at that structure, we have state A, and we have we have Germany, where the company C is, but we have a permanent establishment of company C. So in terms of, let's look at the facts of the case here, is that C pays interest to ASPE because they have a loan with them. So, which is located in state B. So according to state B, there is no PE establishment under the local laws. So state A, according to state A, a PE exists in state B. Okay. So in this case, then the interest income is either taxed in either of A or B states. So how do we deal with that? Based on the BEPS Action 2, then we deny taxation or tax deduction for in respect to the interest expense, or the income is taxed, or the state here includes the income in respect to the amount raising from the PE. Either A to disclose or we deny the interest. But this is also a different structure relating to a PE. So that is a PE hybrid. Maybe we can look another application, and this is a case where we have double deduction. An expense is deducted in both the subsidiary and also deducted by the parent. For example, we have this US parent with a subsidiary in EU or Europe, and therefore, we can see the subsidiary does the purchase of the raw materials and sells the goods. So the subsidiary operates as a standalone entity, purchasing materials from third parties and selling exclusively to third party customers. Okay. So, but given that the subsidiary is a standalone, it may make either a profit or loss. It's a standalone company. So what are the points to note, and what do we need to check here? All the expenses of the subsidiary are double deducted. Okay. Then there is need to evidence that all the income from the sale of the goods included by the parent in US, then they do not have inclusion of that income. Okay. Then what if then this the subsidiary makes a loss? Then the standard loss rules, and they may carry forward the provisions. So we can also have the illegitimate overseas deduction rules, or we can have the interaction with the US dual consolidation rules to curb with the double deduction. So in this case, I think that is BEPS Action 2. I picked a few samples to just highlight what are these some of the structures that talk about the hybrid arrangements. So with BEPS Action 3, in this case, we are talking about strengthening the controlled foreign companies. So
Magdalene,
that
can you hear me?
Yes, I can hear you.
Yes, we have been caught up by time. I think it would be key to kind of go through a bit faster. Thank you.
Thank you. So I will summarize. I'll go in a summary form. So when we talk about strengthening the controlled foreign companies, then here we just come up with the rules to just avoid the BEPS base erosion and profit shifting by having country-specific rules. So I think we can, that is BEPS Section 3. We can move to the next slide, where we will see the what are the building blocks of these the rules for strengthening the controlled foreign companies. So you can see that is the list. I think after this we'll be sharing the slides. So let me not go into detail, but because themselves are details, we have the definition of, we have to, these are the building blocks of coming up with the rules. So each country is supposed to build their rules based on these building blocks. And therefore they have to reference their rules specifically with these headings. Definition of what is that as is a company a controlled foreign company? What are the rules? The rules come up with the rules for computing the income, threshold requirements, attribution of the income, definition of control. I think this is happening within East Africa. Rules for preventing double taxations, Steve talked about, and what are the rules, or what is the definition of that income for the foreign controlled company? So these are the building blocks that now guide on the application of the BEPS Section 3. Let's look at BEPS Section 4. I think here I've talked about, when I was talking about the hybrid instrument arrangements, I mentioned about interest deductions, but BEPS Section 4 comes out with specific rules on interest deduction and other financial payments. And this is where we have had the tax authorities, or they have come with different approaches on how to restrict interest deductions. And that's where we have had the thin capitalization rules coming. BEPS Section proposes for a fixed ratio and for the specific entities, so that it will be capped at a certain percentage of the EBITDA. For the group ratio, then it allows that the group will concentrate their net interest, and in that an amount equivalent to the net EBITDA of the group. So it's a fixed, they are proposing for a fixed ratio. And currently, I know in Kenya, it's recently 30% of the entities. So I think this is about restriction, which is about touching on thin capitalization rules. Maybe you can move to slide to the next BEPS section. So I think I'm not going into much detail about this. It's about transparency and substance, whereby we have global standards have been set up. How do we get to reach out to the information about the preferential preferential tax regime countries? And much of it is about exchange of information. And I think and especially on substantial activity in relation to intellectual properties and the rest. So I think this one is focusing on peer review, so that we have people, the countries, all countries are able to share information about the taxes for the different multinational companies in different countries. So I think Steve talked about this in detail, so let me not focus on that. Yes, I've mentioned about transparency, which is a key issue, and we have seen that global standards have come up. These are the developments, and recently we have the recent one is the Global Forum for Transparency and Exchange of Information for Tax Purposes. So these are the development of tax transparency. We can move to the next slide. I've talked about the Global Forum, which has 166 members, including the G20 countries, and that is part of the approach to make sure that there is transparency in sharing of information, including the implementation, the peer reviews, and also the capacity building to assist the specific countries on the issue about sharing of information. Yes, we can move to the next. Yes, and the global standards that have come up. So yes, we can move to the next slide on BEPS Section 6 about treat abuse. And basically, I'll summarize this in two aspects. That when you're having a treaty, the proposal is that a treaty between countries should not be meant for a purpose of either reducing either payment of tax or avoiding tax. And the provisions about this, they work towards reducing treaty shopping, whereby countries only have specific treaties or sign treaties so that they benefit from payment of taxes or reduction or tax avoidance or reduction in payment of taxes, or you identify a certain treaty specifically because of a tax benefit. So the rules are having treaties that are planned or strategically set to reduce payments of tax. So in this case, we have these two elements: non-creation of opportunities for taxation, and also inclusion of specific rules that prevent treaty abuse, including treaty shopping. So we have also the issue about peer reviews to ensure that the agreed minimum standard is implemented by the member countries. So that's about treaty abuse. The next slide. I'll talk about permanent establishments. Recently, we have had review of definition of what is a PE, and the rules are against permanent establishments or multinational setting up branches with the purpose of having artificial avoidance of payment of tax through either commissioner arrangements or focusing on a specific exemption because you want to maybe appear as an exempt entity, or fragmentations, and also splitting of contracts. If you have to do the splitting of contracts or fragmentation or commissioner arrangements or those specific exceptions, then they are not supposed to be channeled for tax avoidance. So as for splitting of contracts, we are talking about the purpose test, the principal purpose test. And if you are splitting the contract, then you should justify why the purpose, what was the purpose of splitting the contract? Was it because of a business purpose, or it was meant to reduce or avoid payment of tax? So there is, I would have gone deeper in principal purpose test, but because of time, I think we can reach out after this for questions. I think I've talked about that. It's also detailed here. So let me not dwell on this on BEPS Action 7. I wanted to talk specifically about BEPS Action 8 to 10. So aligning transfer pricing outcomes with value creation. Now, this is a very key item or a key BEPS Action plan. In this case, we are just being reminded that the profits should be aligned with the economic activity that produced the profits. Okay, so you should, and that's why it rotates around the arm's length principle approach as one of the TP, the cornerstone of the TP rules. Because if you do not justify this income came from this economic activity, then you'll not be have aligned your transfer pricing with the value created by that economic activity. And that's why we are called for, as much as we have documented our transfer pricing policy or documentation, we should be able to justify, is this the real case on the ground? Suppose the tax authorities come in, are we able to justify this? This is what happened, and this is it. So we are called to provide documentation or supporting documentation. And I would say that transfer pricing has moved from a documentation to a more of an investigative or kind of an audit approach, whereby whatever we are putting in our document, transfer pricing document, we should have supporting document for the same. In the case of an audit, we shall be able to justify that. So that will have shown the tax authorities our profits align with the value created by the economic activities. So we have action number 8, which we can move to the next slide. Action number 8 talks about the intangibles and the cost contribution arrangements. We should be able to know who is the economic owner of this intangible, who is the beneficial owner, and is the revenue allocated in the right way, such that each person has earned profits from the economic activity that generated in relation to the intangible. Where, for example, we have cost contribution arrangements, whereby intangibles, companies a group comes together and they contribute towards development of an intangible. Then we should be the apportionment. We should be able to see the apportionment of the profits depending on the functions performed by each party in the development of that intangible. So in this case, we have to discuss, or we have to support that the DEBE actions, we have to show how each person contributed to the DEBE function, that is the development, the enhancement, protection, maintenance, and all that. We should be able to justify if it's company A did this, company B did this, and is the allocation aligning with the value created by that intangible. Action number 9 takes us to the contractual allocation of risks and the resulting profits to the risks. So in this case, we should be able to justify that the risks borne by this party in the contract are worthy the amount of profits earned. So in this case, I'll talk about the fully pledged distributors, risk distributors, and we also have limited risk distributors. So for the sake of, you realize the fully pledged risk distributors, then they earn or they incur or they assume all the entrepreneur's risk, and therefore they are supposed to be, they should earn a return that is higher return compared to the limited risk distributor. So the risk, the allocation of the risk should align with the profits. The higher risk, higher return. Those who have have assumed lower risk, then they should earn also a lower return. And now this one alone will be able now to justify that the allocation of risk is according to the value created in the transaction. This section 10 is about how do we focus on issues relating to high risk areas, recharacterization of transactions, and also using abusive transfer pricing methods in justifying that this transaction is according to the arm's length. So above the action number 10 is we should be able to justify the way we have described the transaction is the way it is on the ground. I would have wished to give an example, but let me talk about the transfer pricing method. Selection of the transfer pricing method should also align with that. So I think my time is ending. BEPS section 11 is talk about how is the BEPS section going to improve on provision of data. One of the issues is that this action proposed for enhanced data sets and analytical tools, and also for improvement of quality of data. So we have seen those three milestones, with the recent one, the fourth edition in 2022. So it's still on the move, and I think this is about the quality of the information for monitoring and measuring the BEPS action, whether it's taking effect. So BEPS action number 12. This about the mandatory disclosure rules for those countries in the different preferential tax regime areas like the offshore companies, and there's a demand to have mandatory rules for disclosure of this, so that those who have aggressive tax planning, they're able to justify before their court. And therefore, there should be a balance between, are you able to disclose by yourself? That's why in Kenya, we have voluntary disclosure, or you are waiting for the tax authorities to come and catch you. So there are rules rotating around that, and that there should be that balance about, so that you don't strain the taxpayer, and the tax authorities are also in line with the BEPS. So it guides on how do we structure those rules. So BEPS section 13, this is the recent one. It's about re-examining of transfer price documentation. And recently we have had the proposal to have the country-by-country reporting in East Africa that is happening, whereby there is also a three-tier structured approach to documentation. You must have the master file, the local file, and you should file the country-by-country reporting. So basically, it's about enhancing transfer pricing and documentation and transparency to the tax authorities by provision of those. So one key thing is that this BEPS Section 13 is really working terribly on many companies, and there are requirements. I think after this, we can respond through questions. Maybe we can share emails and maybe respond on what is expected on this. How do I file a country-by-country reporting? Yeah, so this is also provided here with thresholds of 750 million euros. So those multinationals with that threshold, then they're supposed to comply with the rules as we have discussed up there. However, this BEPS Action 13 provides three items, or I say two items. There is a template for reporting disclosing the country-by-country reporting, and then there is also the model legislations, and also a competent authority agreements which have to be signed. I think most countries have already signed. So we have, I think in Kenya we have signed with several countries for exchange of information, so that we ensure that we comply with BEPS Action 13. So the tax authorities are keen. So it's for the multinationals now to focus and see, are we complying with this? Have we submitted our CB report within timelines? Like in Kenya should be, there are timelines that have been given for the master file, local file, and also the CBC report. We are going to see that in the next presentation. So we are finishing with the BEPS 14, which is about the dispute resolution. I think this one Steve talked about, and this is a tax dispute resolution between tax treaties, whereby they have come up with mutual agreement procedures for that. So let me note that the rules will guide on how to solve disputes amongst treaties. So let me not focus on that, and I can finish with BEPS Section 15, which talks about the multilateral instruments that guide the bilateral treaties. How do we, if they want to make an amendment in a bilateral treaty, then this multilateral instrument will be able to be a reference point to guide how they are going to structure the amendments. So with that, I think I'll stop that for the next presenter, and sorry for taking your time. Yeah. Thank you.
Thank you so much, Magdalene, for that presentation. It's been quite elaborate in regards to all the action points. And right about now, we are going to proceed to our next item, that is a discussion on the adoption of the various developments that Magdalene was just discussing. And why this is particularly important is because there have been several variances in terms of how the rules that Magdalene was talking about have been adopted in several countries. That is from a perspective of legal ratification and also capacity to implement all of them. For instance, if you look at Action 8 and 10, for them it may have been easier from the perspective of legal ratification, given that various jurisdictions have regulations that recognize the OECD rules, and if they're amended, then that just simply follows that they're applicable. But then you have items like Action 1, and if you'd had what Magdalene was mentioning, there are several issues like thresholds and the minimum rate, which several countries may disagree. For instance, how the United States was saying that for them, they already have a global income law, a global intangible low taxed income rules, acronized as US GILTI, and they're saying they should operate hand in hand with the minimum service tax. We have also seen some countries go as far as enacting their own unilateral digital service taxes. So it's very important to know how East Africa has operated on that plane. And that's why I'll be inviting Mrisho from Tanzania to address us on the developments in Kenya, Ethiopia, and Tanzania in regards to adopting some of the items that Magdalene was talking about. Mrisho, are you there?
Yes, I'm here.
Okay, let me share your screen from this side. Mrisho, can you see my screen?
Yes, thank you, James, for this. So I'll take you through the adoption of BEPS in East Africa, East Africa region, that's Kenya, Ethiopia, and Tanzania. So most of these action plans have been explained by the previous presenters. So what I will do is only to check their adoption applicability in this East African countries. So if you can go to the other slides. Next slide. Yes, from there now. Yeah. So as we have seen from our last presenter, that the first action plan was to address the tax challenges of the digital economy. Ideally, the digital economy is referred to the use of IT or information technology that created for the market consumes of goods or services, which is can be resulted to digital taxes. So these digital taxes, if I explain them in country-wise, starting from Kenya, that digital service taxes is applicable on income derived or accrued in Kenya from services offered through a digital marketplace. So also the digital marketplace has been defined that is a platform that enables credit that is direct between buyers and sellers of the goods and services through electronic means. This was first introduced in the Finance Act of 2020 and it became effective from 1st January 2021. So DST rate in Kenya is 1.5% of the gross transaction. So this gross transaction value, in case of the provision of digital services, the payment received as a consideration for the service. And in case of digital marketplace, the commission for the fee paid to the digital marketplace for the use of the platform. Sorry, go to the next slide. Note that the gross transaction value is exclusive VAT. The next one is application of digital service tax in Ethiopia. So in Ethiopia, there is no specific legislation on taxing to tax non-resident suppliers for electronically supplied services to be provided to customers. But in Tanzania, in July 2022, the Finance Act introduced both VAT and income tax on digital, that is electronic services provided by non-resident person to resident individuals at the rate of 18% and 2% respectively. That is 18% of corporate tax, income tax, and 2% of the VAT. That is a non-resident entity which is providing electronic services to a resident individual is required to register themselves for VAT and accounting VAT on the sales at 2%. At 18% is VAT and 2% on the income tax, and this is go perpendicular with the so-called the VAT representative under the same VAT Act. So I'll take you through very fast because most of this have been explained. Action number 2 is neutralize the effect of hybrid mismatch arrangement, as my previous presenters have explained on this. That the hybrid presenters, to neutralize the effect of hybrid presenter, that's mismatch. That just in a situation of explain difference in the tax treating of an entity or instrument under the tax of two or more jurisdictions. So how we can utilize this is through harmonization of domestic tax laws or general specific anti-avoidance rules or specific anti-avoidance rules or rules specifically applicable to the specific countries. So I've highlighted this, how we can utilize this. For example, in Kenya, there is an introduction system such as e-taxi and interacted customers. We have this customer management that have been introduced by the KRA. We have a transfer pricing regulation. We have a thin capitalization. This is just a ways to neutralize this effect of hybrid mismatch. So in Ethiopia also we have transfer pricing rules. We have thin capitalization or thin capitalization rules. Sorry. Same in Tanzania. We have transfer pricing rules and thin capitalization. So we have also the so-called control foreign trust and cooperation that we have. We'll have a look in the next slide. We have a change in control that is under Section 56 of the Income Tax Act. So in action number 3 is strengthen control foreign cooperation rules. So in general, CFC is defined as a foreign company that is either directly or indirectly controlled by resident taxpayers. So comprehensively, the effect of CFC rules have the effect of reducing the incentives of shifting profit from market jurisdiction into low tax jurisdictions. So how this one have been addressed by different countries, starting from Kenya. So Kenya has no specific, no specialized rules regarding CFC. However, entities that are managed and controlled in Kenya are considered resident entities. Same applied in Ethiopia. Ethiopia also has no specialized rules regarding controlled foreign companies. Next slide, please. Next slide. So previous one. Yes. So in Tanzania, foreign trust and cooperation, and their members shall be taxed in accordance with the Tanzania Income Act. But a CFC in Tanzania under the Income Tax Act is a non-resident corporation in which a resident person owns a membership interest, whether directly or indirectly, through one or more interposed non-resident entities. And it is treated as distributing its unallocated income to its members at the end of each year of income. So this is under implementation now, because the Tanzania Revenue Authority are taking under Section 75, sub 6 of the Income Tax Act to tax unallocated income for the entities under CFC, and such incomes will be taxed under the Income Tax Act. So under CFC now we have seen that the strength and control foreign cooperation under BEPS, it has been implemented in that way. Another slide. We have also limitation on interest deduction. My colleague have explained much on this, but you can see that in Tanzania, in Kenya, I think capitalization rules are applied when the debt to equity ratio exceeds 3 to 1. That is more than that is not allowed. In Ethiopia, thin capitalization rules that apply where a foreign controlled resident entities where 50% or more of the membership interest is held by a non-resident person alone or together with the other related persons. That has averaged to debt to equity ratio, which is 2 to 1 for the year of income. But in Tanzania, debt to equity ratio is 7 to 1. Sorry, next slide. Next slide, please. So in Tanzania, the debt to equity ratio is 7 to 3. That is which is applicable to the so-called exempt controlled entities. That thin capitalization rules applies to exempt controlled resident entities for the year of income. Now, who is the exempt controlled resident entity. So this is a resident entity at any time during the year of income, of which 20% of its income or more, 20% of the ownership of or more of the entities held by entities exempt under the second schedule. That's first criteria. Second criteria is owned by approved retirement funds. Third criteria, it's owned by the charitable organization. And the next one is non-resident person or association of the entities. So if a resident entity in Tanzania, it's 25% or more is owned by non-resident persons, then the interest deduction or claim of interest in pendio is restricted to 7 to 3. So more than that is added back during the income tax computation. Next slide.
Mauricio, we have about 5 minutes, so.
Okay, control the harmful tax practices more effectively. So this one has been explained by my previous presenters. So go to the next slide. Yeah, prevent tax treat. So over the years, bilateral tax treaties by most of the jurisdictions in the world have served to prevent harmful double taxation treaties. So how to solve this one? Basically, in Tanzania, beneficiaries of treaty entities should be owned by a resident person of the contracting state who have underlying ownership of more than 50%. This is under section 128. This is under section 128 of the Income Tax Act in order to combat the so-called treaty shopping. Next slide. Next slide is to prevent the artificial avoidance of permanent establishment. So permanent establishment, this has been explained in different countries as have been. So in general, permanent establishments classifies when the non-resident person business activities in order to, in other countries. So non-resident persons conduct a business activities in another tax jurisdictions over a given period, leading to a tax presence in that territory. The next study, please. So in Kenya, as what we have seen in the previous presenters, so a business carries in Kenya through a fixed place of business give rise to PE. So as does a building site or construction or sample projects that has existed for 6 months or more. The definition of PE is extended to include also dependent agent that habitually conclude the contract on behalf of others. So this has been more extended in Kenya on the PE definition. Another slide. So in Ethiopia, a service PE, a business carries out whole or partly through a fixed place of business or exploration, extraction of minerals is also have a risk to PE. So definition of PE in Ethiopia in a local tax legislation also include a service permanent establishment and independent agent PE concepts. Another slide. So whenever we go to Tanzania, in Tanzania definition of permanent establishment to mean that a place where a person carries on business, and this including a place where a person carries on business through an agent or other than a general agent of independent status acting on ordinary course of the business, or a place where a person has used or installed or is using or installing a substantial equipment or substantial machinery, and C, a place where a person is engaged in construction, assembly, or installation project for 6 or more periods, including a place where a person is conducting a supervisor. So also a place where a person is conducting supervisory activities in Tanzania is in relation to a project is termed as a permanent establishment. Another slide. So in action point number 8 to 10, as previous presenters have highlighted, that's assume that the TP outcomes are in line with the value creation. This means all transactions in the TP document should align with value creation. That's intangible intangible. The OECD identified 3 actions related to ensuring that the transfer pricing outcomes are in line with the value creation. That's action number 8, which is intangible. Action number 9, which is risk and capital. Action number 10, that's the higher risk and higher risk transaction, which all this have been covered by my previous presenters. Another slide. Action number 11, that's the establishment methodology to collect and analyze data on BEPS and value creation. So this action plan highlighted the lack of quality data on corporate taxation that has been major limitation to ensuring that fiscal and economic effect of tax avoidance, as well as any effort to ensuring that the impact of the implementation measures agreed to part of EP projects. So implementation in East Africa, how this one was being implemented. This was implemented by introducing an electronic filing system to most of the countries, whereby in most countries in East Africa, returns are filed electronically and introducing some legislation to combat the tax avoidance. So that in order to combat tax avoidance, then there is establishment of to collect and analyze that BEPS and the creation data and the creation to address the same. Next slide. Action number 12, that's require taxpayers to disclose their aggressive tax planning arrangement. This is somehow, I'm not sure if this one is very simple to taxpayer to disclose, but it's only through making sure that you follow the laws and the regulations in the preparation of your documentation. This action plan contains recommendation regarding the design of mandatory disclosures. So this mandatory disclosures in East Africa is implemented under the introduction of the system, like such as e-tax. You see, so if you are you file return using the electronic, it means that your information is more disclosed. The transfer pricing regulation, you can see the transfer pricing regulation in East African countries. They have directed how the taxpayers should comply with the same, including the timing of filing or presenting this transfer pricing regulation and the thin capitalization. All this thin capitalization and the CFC trust that we have seen is only the tools to combat taxpayers that they can disclose their arrangements in their financial transactions. Next slide. The 13 is to re-examine transfer pricing documentation. So this action plan explains the implementation update to be placed by a new or enhanced summary report in a table format that offers a snapshot of implementation of country by country reporting, master file and log file, as well as the transfer pricing documentation requirement around the world. This one also has been covered by my previous investors. So in Kenya, following the update of the OECD BEPS action 13 documentation guidelines in numerous countries across Africa, Kenya has introduced an amendment that requires resident companies in multinational entities group with a turnover of Kenya shillings 95 billions, almost euro 750 million, to adopt the 3-tiered approach to transfer pricing documentation. So they are required to file country by country and master file and log file with the Kenyan Revenue Authority. This is in respect of Kenya. Next slide. So in Ethiopia, Ethiopia has a transfer pricing provision and the rules that the regulated dealing between the related parties. The rules require taxpayers to have a transfer pricing document in place at the time of filing the annual CIT return. The rules regularly for organization to follow the OECD guidelines. These rules also for Ethiopia, it's follow the OECD guidelines and they apply to both resident and non-resident related parties. So the Ethiopia transfer pricing rules require transaction between the related party also to be at arm's length. I think this is overall between overall in East Africa that the guidelines require transfer pricing requirement transaction to be in related to be in the arm's length rules. Next slide. So in respect of Tanzania, any person who participate in a controlled transaction, that a transaction is associate or related party is required to prepare or maintain a contemporaneous transfer pricing document in Tanzania. So the transfer pricing regulation specifically specify that where a person engaged in a controlled transaction, so if that related party transaction is exceeding 10 billion Tanzanian shillings, which is approximately to 4.3 million USD. Such person is required to submit the TP document along with the income tax return by the time of filing it. So it's therefore important that the transfer pricing documentation should be prepared and maintained by all companies having related party transaction. This is irrespective of Tanzania entities. Next slide. So make dispute resolution. This also has been addressed by my previous presenters. So check next regulation. Sorry, next slide. To check this in Tanzania. Sorry, previous one. Yes. So settlement, this dispute resolution, settlement of tax dispute in Tanzania, this follows for the years handled in several manners. But currently, Tanzania now the Finance Act 2021, among other things, introduced the so-called amicable settlement of tax disputes through mediation at the Tanzania Revenue Appeal Body and Tanzania Revenue Appeal Tribunal and the Finance Act 2021. Parties now will have the right to appeal, to apply their dispute to be settled through mediation. The Finance Act also, I remember that we have introduced, apart from the amicably, we have a tax ombudsman offices that issues that have been objected to the TRI, they can be addressed to the tax ombudsman and solved it. So this is just a mechanism now to make a dispute resolution mechanism more effective in Tanzania. Next slide. So we have now developed a multilateral instrument as previous investors, presenters have presented, but this in East Africa, only Kenya signed this one in November 2019, Kenya have signed this one. So in November 2019, over 100 jurisdiction countries negotiated on the BEPS that will swiftly implement a series of tax treaty measures to update international tax rules and raise the opportunity for the tax avoidance by multilateral enterprises. I think this makes the end of my presentation. Next slide, please. Yes, this makes the end of my presentation. I welcome the next presenters to proceed.
Yes, thank you so much, Mrisho. We shall right away go to Jumabuli to speak about the adoption of BEPS action points in Uganda, Rwanda, and South Sudan. So Juma, the day is yours.
Thank you, James. I'm going to share my screen. If you see my screen. Yes, I'm going to share my screen. I'm sharing screen.
Okay, let me help you share the screen. Juma, can you see my screen?
Can you hear me? Okay. Thank you, everyone. My task is just to talk about how BEPS has been adopted in Uganda and Rwanda. The previous speakers gave us a general overview of BEPS. So I'll not go into the details of what which action point, what each action point is all about. I'll be just talking about how the BEPS have been adopted, particularly in Uganda and Rwanda. The previous speaker spoke how BEPS has been adopted in Kenya, Tanzania, and Ethiopia. So in the interest of time, I'm going to be quite fast. I'll not talk, next slide, James. So in Uganda, we have adopted action point 4, which is about limitation of interest deductions. So BEPS action point 4 says that interest deductions should be capped to a taxpayer's earnings, taxpayer's EBITDA, which is earnings before interest, tax, depreciation, and amortization. So in Uganda, this action point was adopted and our laws were amended. And when you look at how the law was amended, particularly in section 25, you will find that the actual adopted action point 4. So what happens is that when you're doing, if a company is a member of a group, that the interest deduction of that company is capped to 30% of its EBITDA. So the conditions are that the company must be a member of a group. So if any part of the interest is not deductible in that particular year, the law allows you to carry it forward in the next 3 years. So that is how BEPS action point 4 has been adopted in Uganda. Just a few exemptions there. Financial institutions, insurance companies are exempted from this because of their nature of operation. They have a lot of interest expense. So if you apply action point 4 on them, then a lot of interest expense will not be tax deductible. The other regarding treaty abuse, yes, we have provisions in our local laws which try to avoid treaty abuse, and this is particularly putting in place limitation of benefits clauses. So for you to benefit from the reduced rates or the exemptions, you must demonstrate certain things. One of them is a economic substance. The other is beneficial ownership. So this is one of the things that is in our laws, which help to limit treaty abuse. Next. No. The slide before that. Before that. Before that. Okay. Next. The other on treaty abuse, Uganda announced a cessation of tax treaty negotiations because we noticed that some of the treaties that we have were not properly negotiated. So as a matter of policy, there's a temporary cessation so that there is a clear policy on how to get the best deal out of these double taxation agreements. The other one is preventing the avoidance of permanent establishments. You know, that is one of the ways that multinationals do aggressive tax planning. So what has been done in Uganda, we have adopted what we call a service PE in tax language, which means that if you come in Uganda and you do certain services through people who are not independent in their operations, then you have created a service PE. So that helps to ensure that multinationals which come and do operations in Uganda do not avoid creating a permanent establishment in Uganda. It has also been adopted in certain DTAs. For instance, in the Netherlands, Uganda DTA, there is that provision of a service PE. The other is the action point regarding the multilateral instrument. This one, the purpose of this, as Magdalene mentioned, is that they are trying to use this instrument, an MLI, to renegotiate all treaties which were not properly negotiated. Instead of negotiating treaty by treaty, this instrument is going to, have one instrument, and all those treaties which a country has signed up will have better terms. And as you are aware, many countries have signed up to this MLI. Now in Uganda, we have not yet signed it up, but from information we have, we are going to sign up. And once we sign up, this means that all our treaties we have will be covered. That is in case if the countries which also signed with us have also signed with the MLI. So this is something that we're expecting to happen in the near future, which shows that Uganda is actually adopting action point 15. That is it mainly. So I've talked about action point 4, then the treaty abuse. So that's where we are so far, and you clearly see that the tax policy department at the Ministry of Finance and the URA are following keenly what is happening in the international space regarding BEPS, and they are picking up things which are relevant to us. So I'll go to Rwanda. I'll go very quickly. Uganda, I should have, before we go to Rwanda, when it comes to the digital economy, we, in the income tax amendment bill of July, of the most recent one for the financial 2023-2024, we had a digital services tax which was being introduced in the form of in the form of withholding tax. So that one, we had it in the bill, but when it went, when the act came out, that was dropped. Although it was dropped, it shows that we are getting, the country is, Uganda is looking at that action point 1 and see how to tax the digital economy. So in future, we are likely to see a similar thing that is in Kenya, of introduction of the digital services tax. For VAT, we already have something in place. People who are consuming, people who are providing electronic or digital services in Uganda are required to register for VAT and comply with the VAT rules. So that is something I wanted to mention about action point 1, that is addressing the tax challenges from the digital economy. So I'll go to Rwanda. Rwanda, they are also doing something around the taxation of the digital economy, and they have introduced, they have a digital services tax, which also applies in the form of withholding, and they are applying it, what they have defined what digital services are, and they include online advertising, supply of user data, online search engine, social media, and online media. So in Rwanda, it also works in the form of withholding, which means when you are paying for these services, you withhold tax. The current rate is 15%. There is also a draft law which requires persons providing electronic services to comply with the VAT rules, which means they will have to register for VAT and charge VAT for these services. Next, next. So I'll talk about lastly action point 13. Magdalene talked about it. Action point 13 requires that when it comes to your transfer pricing, you adopt a 3-tiered structure, which means that you must have a master file which details all the transactions in the group. Then you are required also to have a local file, that is a file for each country, then a country by country report. That's the 3-tiered approach when it comes to action point 13. So what Rwanda has stated in its laws that if the country, that if there is a subsidiary in Rwanda and the parent of that subsidiary is required to comply with action point 13, which is country by country reporting. If the parent is required to comply with action point 13, then they should submit the country report for Rwanda, because the parent will have to submit a country report for wherever they have a subsidiary. So what Rwanda is saying that if you are required to comply with action point 13, give us a country report for Rwanda. So this is how they have adopted action point 13. They're not adopting it in its entirety, that if you are an entity in Rwanda and you are supposed to have a master file, then a local file, then country by country report. No, they are saying that you submit a country report for Rwanda if the parent is required to comply with action point 13. That is it in a nutshell. In South Sudan, we've not seen a lot of adoption of BEPS since the country is new. Even its transfer pricing regime is really also very new. Yes, the laws, they are required that you must comply with the arm's length principle, but in terms of enforcement is very low. So similarly, when it comes to BEPS, we've not seen a lot of interest by South Sudan in terms of adopting the various action points. That is it in a nutshell. Thank you very much. Back to you, the host.
Thank you so much, Juma. Juma, if you could mute your microphone. Thank you so much, Juma, for that presentation. And hopefully all of you, what we've learned today involves that 3 aspects, mainly that in relation to all the action points, there are some that have been quickly adopted and only issues in implementation remain. For instance, action 8 to 10 and action 13 on transfer pricing, as earlier said, in terms of legal adoption. Then there are those where there have been some slight adopting and a few things remain. For instance, action 6 and 7 on treaty abuse and prevention of artificial permanent establishment, because those await the adoption of the MLI with a full package on solutions. And some of our countries in the region haven't yet adopted it, but are planning to do so. So that is something to look forward to. Then there are those where adoption has also been partial, and in other instances, there are still some issues to iron out, like action 1, where on the VAT side, it's completely adopted in terms of electronic services. But on the income tax side of Pillar 1 and 2, the regional countries have tended to bring in the unilateral digital service taxes, which are frowned upon by the Pillar 1 and 2 solution. So it remains to be seen whether the East African region adopts Pillar 1 or 2 instead of the unilateral digital service taxes. At this point, it's very important for us to get into a discussion of how BDO can be able to assist in terms of any service in relation to these developments. So I will invite Juma, in the absence of Steve, to give some closing remarks and also highlight how BDO can be able to assist. This will take us around 5 minutes. So Juma, the day is yours again.
Thank you, James. But from the discussion we've had, it's quite clear that revenue authorities across East Africa are watching carefully what is happening in the international tax space. The OECD is a sort of a tax think tank that comes up with that looks at the international tax regime and see where the loopholes are, and then come up with proposals on how to close these gaps and how to help revenue authorities collect more revenue. There are also other initiatives like the tax inspectors without borders. So there is a lot of assistance coming from international space to help governments collect more revenue, because I think the Western world has noticed that aid is not sustainable. So what they're doing is they're helping countries, especially the third world, to collect more revenue, and that is how the OECD comes in. It's a tax policy think tank. It comes up with what are those gaps, especially in the international tax space, that can help governments collect more taxes. There is also need, of course, from the Western world to collect more revenue from companies, since many multinationals are spending a lot of money around tax planning. So to counter that, OECD is coming up with proposals to counter this aggressive tax planning, and that's the whole reason for the BEPS action points. There are 15 of them, as we have discussed. So governments are keenly observing what is happening across the world, and they are adopting all these things in a phased manner. And once these are adopted, of course, that imposes a compliance burden on the companies that are required to comply with these rules, because they are quite complex. And I mean, every company should be keenly observing how do we comply, because if you don't comply, the rules are clear. You have to suffer the penalties. So we are available to support. As you've seen, many BEPS action points have been adopted across the region. I'm sure you have our contacts in Uganda, Rwanda, Tanzania, Ethiopia. Please reach out, and we can support you. We don't want you to. The reason we are doing these webinars is we are trying to create awareness, so that our clients and the prospective clients know what is happening, what revenue authorities are trying to do to collect more revenue, so that you're not caught off guard. Once you're aware, then we can start a discussion so that you mitigate any repercussions that can come with non-compliance. So reach out to us, and we shall have a discussion on how to support you. Thank you very much, and thank you for listening to us. We wish you the very best. Thank you.